Welcome to this edition of the State of the Economy. And yes, almost everybody has an opinion on what the state of the economy is looking like or what it could like over the course of the next 6 months as well. So some of you might think, okay, why are we talking about this? But I think it's important to look at the nuances, try and look at some trends, some data from history, and try and assess this situation. So let's get in. Pranjul Bhandari, she's joining us right now on the show, Chief India Economist of HSBC. Pranjul, so good having you. Thanks so much for joining in. Um, at the outset, Pranjul, what did you make of the numbers and the data that came out? And are they now futile to talk about too much simply because they were in the quarter which was not impacted by COVID-19 any which ways, majorly?
Yes, I think so. I think you're right. But having said that, the number that we got for the quarter, which was 3.1% for the Jan-Feb March quarter, I think it's just a matter of time before it's going to be revised downwards. And the reason is that the CSO in their press release very, very categorically mentioned that they had issues collecting data because a lot of the deadlines, of data reporting of 31st March had been pushed outwards because of the lockdown. So there's definitely going to be some revision to the downside. We think once the data is revised appropriately, the 3.1% number will be closer to around 0.4%. That was our forecast. It's based on some activity indicators which seem to suggest that things were much worse than the GDP number showed it to be. So, for example, GDP manufacturing contracted by 5%. But if you look at some other data, for example, IIP manufacturing, it contracted by 17%. So once you include all of this, I think it'll go down to about 0.4% of GDP year on year for the Jan to March quarter.
And what does that tell us about how the year could be like? I know various estimates are there. The worst ones probably pegging in a negative 5%, 6% number for FY21. And I know it's very difficult to forecast, but there are lots of moving pieces, and therefore I would want you to dwell on them. The economy opening up factor, but even if it's open, not operating at full capacity factor, people not spending as much as they have been used to. How do you piece together all of these?
Yes, sure. So, look, our own estimate is that in the month of March alone, activity contracted 50% month on month annualized. And in the month of April, it contracted a further 85% annualized. These are really big numbers. And, that's what you get when you're in a national lockdown. But having said that, I think April is the bottom. Things are looking much better in May. And the reason is just that we are opening up. So let's consider this. In the middle of March, 70% of the economy was locked down. In the middle of May, about 70% of the economy was gearing to open up. And I think by about mid-June, 80% of the economy would have opened up. So of course, if more activity is opening up, then growth will go up. And that's what we're going to be seeing. We started seeing it from the middle of May, but we're probably going to see it for the rest of June as well. Things ticking higher. We've already seen electricity consumption go up. Today we got the PMI manufacturing data, which showed an increase, in the month of May compared to April. So things will be markedly improved over May compared to April.
But what does that still tell you, Pranjul, about what the quarters ahead could look like? My question, though, rather is that is it, while you can look at it in an aggregate, is it very difficult to comprehend what the actual numbers could look like, because we do not know the way in which the Indian buyer or the Indian consumer will come back. Normally, the first 2 months might see some pent-up demand, but you don't know if that will extend because there have been job losses and there have been salary cuts as well.
Look, I'm glad you answered this because this is the key question. What we are seeing right now is this pent-up consumption demand, which is leading to inventory restocking demand and hopefully will spill over into some manufacturing demand. So all of this will look good and see us through, probably whole of June at this point. But the problem is, what is the component of this demand? I think the component of this demand is essential goods and services, mostly consumer non-durables like soaps, shampoos, and so on and so forth, which people were not getting enough access to. Now they have, they're going and restocking on that in a big way. This makes up about 30% of the economy. Essential goods and essential services makes up 30% of the economy, and this is what's going to see us through. The worry is once this wave of demand is behind us, it's over, what's going to drive the economy? And that's where we don't have any great answers. We don't have any good drivers. You see, a few things which support growth, for example, finance, for example, capital, and for example, labor, each of these have got hurt over the last few weeks of lockdown. A lot of labor has gone back home. A lot of banks have become incrementally more risk averse. And of course, capital is the thing which you sort of push to the back burner first when things start going a bit wrong for you. So we don't have any great drivers of medium term growth. And I do think that beyond the first wave, which is going to last us about a month and a half or so, we don't have any strong drivers. Consumption is one side of the coin, and the other side of the coin is savings. And I think it's good to think about that as well. Generally, if you look at India in the last 10 years, each time we come out of a slowdown, we actually find that India's savings rate has gone down. And that is because people try to smoothen their consumption by lowering their financial savings. I think this time is going to be quite the opposite. We may actually end up increasing, if not stabilizing, but increasing our savings rate. And the reason is twofold. One reason is because labor market is progressively weaker, weaker employment, weaker wages, people may not want to go ahead and buy too many consumer durables. These are expensive things. When your wages have been cut, you don't want to go and buy a new car, a new air conditioner, and things like that. And the second reason is that a lot of the consumer durable demand over the last couple of years has been fueled by personal loans. And to the extent banks and NBFCs are going to be a little more risk averse now, they may not want to give out those loans as freely as before. So just bringing all of this together, we are seeing a spurt in growth right now as the economy is opening up. This spurt, by my estimate, is driven mostly by consumer non-durables and basically essential goods and services. Generally, we would like this to broaden out into discretionary goods and services, but I'm afraid this time that might not be easy. A, because people have lost on jobs and wages, and banks are not ready to fund consumption loans as freely anymore. So we have a growth problem.
Pranjul, so what might actually happen is, and I'm just trying to pick your brains here, that we might actually have lower savings by and large because people have, in the sense compared to normalcy, because wages have come off and job losses have happened. And at the same time, people's propensity to save because they want a safety net might go up. Would you expect that the savings rate, therefore, will kind of shoot exponentially? We're seeing that evidence in France, US, and some of the other countries which have released the data.
Yeah, so as I mentioned, that generally in India, when we come out of a slowdown, we actually see savings fall because people like to stabilize consumption and they are all right to just save for some time. But this time could be quite different. We could actually see, savings rise. Either be flat or rise. Maybe it may not fall, and we're already seeing the first signs of that. Just look at deposit growth at banks; it's rising 10% year on year in nominal terms during a month when GDP is probably contracting 7% year on year. So that basically shows that people are going and putting a lot of money in banks. I would say that India has moved from being a willful spender to a forced saver. We are saving, because we don't have places to go and spend money, or B, we don't want to buy expensive things anymore because our wages are not very strong, and we do want to do precautionary savings in such a delicate period.
It's interesting. So the quantum of money earned in a month is lower, and yet the savings would go up. Therefore, the direct impact on consumption. Thanks, Pranjul, for that point. Now, the other thing is, Pranjul, you raised this point about the financial system and not wanting to lend too much, etc. That is part one. Part two is the kind of stress that the financial system will anyways come in over the course of the next 2 or 3 quarters, arguably because of bad loans and non-performing assets. What kind of impact can that have on the economy, even if the economy were to live back to normalcy, let's say in quarter 3?
Yeah, that's a very good question. And I do think that this couple of weeks of lockdown or couple of months of lockdown is going to prove costly for growth in the medium term. I think it's going to bring down India's potential growth at least by 1 percentage point. And the reason I say that is, one of the main reasons is the financial sector taking a hit. We already were with fragile balance sheets. NPLs at banks were quite elevated. Shadow banks had their own balance sheet problems, and each of them have got further amplified over the last couple of weeks. And I think that's probably something that's going to stay with us. Now, how will the financial system respond? I think it will respond by not being very forthcoming in giving out new loans. And when you don't give out loans, who funds your growth? Remember that if you look at India's flow of funds, 60% of our financial flows comes from banks, because our corporate bond market are still quite nascent and not very liquid. So if our banks are not performing properly, you have a funding problem and you have a medium-term growth problem. So yes, we are going to see potential growth come down in the medium term because of the COVID problem. And one of the key drivers of that is going to be a financial system that is a bit impaired.
Okay. So let's put all of this into perspective then, Pranjul. We have issues galore. There are some responses that have happened, some largely by the Reserve Bank of India. The package that the government has announced, which is not as high as the market would have thought of when the announcement was made first by the PM. How do you look at both the sets of responses that have happened? How effective would incremental moves be, either by the Reserve Bank of India or by the government?
Okay, great. So, let me just set the background for this answer by just mentioning something about India's balance sheets. Now, if
Yeah.
you look at the balance sheets of the key economic agents in the economy, even before the COVID crisis, they seemed a little stretched. Our corporates had high debt to equity ratio, which was rising and was also high compared to our other peers. Our banks had high amount of NPLs. Our shadow banks had same issues, further amplified by liquidity issues, and our consumers had been spending, but spending by taking on a lot of loans, a lot of debt, and that kind of spending can stop once the labor market becomes weak. If my wages have fallen, I don't want to take another EMI. So all the balance sheets were a bit stretched. To be honest, even the government's balance sheet was stretched. The public sector borrowing was already close to 10% of GDP even before the crisis hit us. But unfortunately, it is this very government which will have to sort of ramp up work now, will have to ramp up efforts, because all other balance sheets are stretched. And I think the authorities, which is both the government and the RBI, will have to do all the heavy lifting at a time when all the other economic agents are not in any state of doing too much spending. I think a lot of necessary things have been done. For instance, free food grains, cash transfers, the partial loan guarantee announcements. The RBI has also done, all the three things it's meant to do: cut rates, provide banking sector liquidity, and perhaps some regulatory easing in the form of those, you can pay your loans later and all
Yeah.
of that.
Monitoring.
So minimum has been done, and this is great. It is very good. But I think next steps are needed. On the one hand, we really need to ensure that what's been announced is implemented properly. For example, the 3 trillion rupees loan guarantee for small businesses is actually fairly powerful. It's 1.5% of GDP. But the problem is that it could get killed in its sort of processes. I think the authorities at this point should think of it more like a cash transfer scheme than like a loan scheme in which a lot of due diligence has to be done, because that's the only way the money, the 3 trillion rupees, will reach the small businesses quickly and efficiently. The same with all the supply side reforms that the government has announced. They need to get it done. In a way, it's a movie we watched before, promises of the government doing lots of reforms, but it really needs to do a couple of them quickly, so some excitement about the medium term builds up and has some positive impact in the short run. So in terms of what next to do, I think implement what you've announced properly. B is try to do some new things, and in particular, try to help those sectors which have got left behind in your previous stimulus rounds. I think one such sector is the urban poor. We've reached out to the rural poor in terms of higher Narega and all of that. But I think the urban poor needs a new package, and I think that's something we really need to do at this point. The other thing we need to do is help some of the other sectors, for example, aviation, which are going to be long-term victims of COVID-19, perhaps provide them with some long-term concessional loans or something of that sort. So some more things need to be done at this point.
Can it be fiscal in nature, or do you reckon the constrained balance sheets will not allow a large fiscal response to come in?
Well, look, we definitely have a fiscal problem. It's stretched. It was stretched even before COVID. As I said, public sector borrowing was already 10% of GDP. Government debt was already 70% of GDP. These are very high numbers. Even without any major fiscal stimulus this year, fiscal deficit, government debt, public sector borrowing, all are likely to rise just because of tax revenue shortfall. That is going to be the
Yeah.
big for fiscal this year. So, with that in mind, yes, the space is limited, but I don't think that the incremental space is nil. I think some space can be created even now. Slightly higher deficit can still be run from where we are already. And some repurposing of expenditure can also happen. Like, for example, cut your budget on a bullet train and instead try to give it to, for example, the urban poor. So some repurposing of expenditure can still happen at this point, and some fiscal space of about 0.5% of GDP in the least can still be extracted from the fiscal accounts. The RBI, on the other hand, does have a lot of space and can push a little more, but it may have to push a little more creatively. For example, the TLTRO version 2, in which the RBI was providing concessional finance for NBFCs, it didn't really take off.
Yeah.
What can it do? Maybe it can sweeten the deal. Maybe it can give you even more concessional funding. Earlier, the funding was meant to come at repo rate. Maybe it can now come at the reverse repo rate, which is even lower. So I think the RBI has space, but at this point, instead of doing more of the same, RBI needs to think creatively to either sweeten the current deals more or to perhaps do new things, for example, taking on some credit risk.
Yeah, you were saying that there's a law of diminishing marginal utility to RBI's incremental moves, I guess, Pranjal. In the same vein, in the same form that they're having.
Yes, I think so, because you see the system-wide banking sector liquidity is about 8 trillion rupees right now. Just
Yeah.
adding to that, it's great. It's good that we have excess liquidity, but just adding to that will not give you the growth push that you want at this point. You need to now ensure that it reaches those pockets that are being starved. For example, NBFCs, smaller corporates, anything below AAA rated. These are some pockets where money must reach at this point. And just to push it a little more, I think also state governments. So these are some needy pockets. The RBI will have to figure out what it wants to do. Does it want to become more creative on the LAF window, start accepting things which are not just government bonds? Does it want to become more creative in the OMOs, start buying even state development loans, and not just central government bonds? So these are some things that the RBI really needs to think through, because it has space. It's all about trying some new things for the first time.
Okay, one last question, Pranjal. Is it possible to even second guess that in a recovery mechanism like or in a recovery period that we are likely to see from the bottom in April, as you mentioned, whether the recovery can be really spread out? Does it get bunched up at times because of pent-up demand, etc.? And how long can the lack of recovery process, so to say, last?
Yeah, these are tough questions, and the band of errors to any forecast are going to be very large, because nobody knows how long this pandemic is going to rise, whether we are going to see a second wave. These are still things which nobody knows about. But with the information we have, the way I look at it is that we bottomed out in April. May and June are going to be good because there's a lot of pent up demand in the system, particularly for essential goods and services and consumer non-durables. However, once that goes away, then we have some problem around August, September. There may be some Diwali-related boost after that, but things may flatten out rather than continuously seeing a sequential increase. So I do worry about how things will be, once Diwali is behind us, and that stimulus is that excitement is behind us. That is definitely a source of worry. And for the medium term, I think calling it crudely the value chain of growth, you really want to move from consumer non-durables to consumer durables to investment growth. I think at this point we are stuck with consumer non-durables, which are mostly the essentials. And we are finding it hard to move to consumer durables because loan growth is going to be weak, and then even harder to move to investment because if there's so much uncertainty, who's going to invest? And that is another way of saying that I think potential growth is going to come down in the medium term. In our last estimate, we spoke about it coming down by about 1 percentage points, but of course, this is always work in progress because more data on COVID is just coming out every single day.
Yeah, it is. Yeah, but a lot of moving pieces and almost difficult to comprehend an unprecedented situation of sorts. Pranjul, thanks so much for taking the time out and giving us some thoughts of how this can all unfold.
Great to be here.
Thank you, Pranjul. Viewers, thanks for tuning into the broadcast.